Here at the Planet MicroCap Showcase 2019. This is a panel that we did, it's a little similar to one that we did last year, but last year was called the Best of the Undiscovered. This year it's the Best of the Really Undiscovered. And it's being moderated by one of my good friends who I've had on the podcast now for a few times, and also happens to be my surfing buddy. If anybody else is interested in learning how, we know. But without further ado, I'd like to introduce Brandon Mackie from Small Cap Discoveries. Brandon?
Thank you, Bobby, and it's great to be here. Good afternoon, everybody. Welcome to today's panel, The Best of the Really Undiscovered. As Bobby said, my name is Brandon Mackie. I'm the lead writer for the Small Cap Discoveries newsletter. Small Cap Discoveries is a paid newsletter dedicated to finding North America's best emerging growth companies. In the audience today is Paul Andriola, my partner and editor of Small Cap Discoveries. And to set this up a bit, we talk a lot about, in our newsletter and in past appearances and panels, the discovery process. And this is the cycle of how a company goes from complete obscurity to mainstream recognition, and along with that, the extraordinary investment returns that can accompany successful investment in this process. And most of us have a good understanding of what this process looks like from the outside. Could be a breakout earnings report, a rocketing stock price, a flood of analysts or newsletter coverage. But what we don't often talk about is what this process looks like from the inside. Because long before discovery happens in the mainstream markets, it's happening internally at the company. And understanding how a management team looks at this process from the inside and prepares their team for success and eventually discovery could hold the key to improving our investment returns. So today we're going to talk about the discovery process through the eyes of management. And we're really lucky to be joined by 3 companies that have all successfully navigated this process. And before we get any further, I do want to disclose that Small Cap Discoveries, Paul and myself, we do own shares in each of these companies, which I'll introduce in a second. Okay, so please join me in welcoming Dirk Maritz, CEO of Atlas Engineered Products, Bill Wignall, CEO of Sangoma Technologies, and Kurt Sorschak, CEO of Xebec Adsorptions. Gentlemen, welcome. All right, so I'd like to start with each of you. We'll start with Dirk over here on my left. If each of you could provide a brief overview for the audience of your company and your background, just to set the stage for our discussion. Dirk, please go ahead.
So AEP, or Atlas Engineered Products, for which the AEP abbreviation is genuinely still actually only a startup. We've only listed just short of 18 months ago. The company is playing in this space of engineered products, really satisfying the needs of the construction and residential home builder industry. And what the company focuses on are being top-class designers and engineers and manufacturers of product in controlled factory environments, as opposed to stick frame on the construction sites. It is manufactured in high technology spaces, laser beam precision, and really to the needs of a specific customer. But what makes Atlas quite interesting is that there are hundreds and hundreds and hundreds of these companies across Canada and the US. And AEP has taken the stance to roll up and consolidate that industry since its listing in 2017. Today, we have already 6 businesses merged, 2 in British Columbia, 3 in Ontario, and we've just entered the prairies. A very exciting period, uniquely positioned for growth for Atlas. Thank you.
Kurt?
Yeah, Xebec is a renewable gas company. We basically generate and service renewable gas installation. Renewable gases are becoming relevant as a low-carbon fuel, primarily for gas utilities and in the energy sector. We've been in business for over 50 years. As my CEO always says, we are a 50-year-old startup, so really, really undiscovered. And over the last couple of years, driven by climate change, what we are seeing is a need emerging for gas utilities to join into this renewable energy wave that we are seeing now. Renewable electricity, solar, wind, and the gas utilities are obviously now very interested to add renewable natural gas to their product offering. That drives our expansion. It happened relatively sudden. We've been public for almost 10 years now, and we'll talk more about how we didn't get discovered and how suddenly it happened. But over the last couple of years, we've seen significant growth, and we expect growth to continue because of this renewable energy drive.
Great. And Bill.
Thanks, Brandon. Hi, I'm Bill Wignall. I'm the CEO at Sangoma. We're totally different than the other two companies. We're a traditional technology business, software, services, cloud. It's a global business. We've gone from $10 million in revenue to $100 million over the last few years, from $7 million market cap to $100 million EV. So the company's transitioned incredibly the last few years. I'm a typical tech company. I'm an undergrad engineer, started in engineering, product management, marketing, finance, sales. I've run 5 companies. And I guess we're going to talk about how Sangoma got undiscovered and what changed over the last few years since I took over the reins.
Great. Thank you, guys. And so for our first question is, anybody who's been following the U.S. markets or the Uber IPO knows that being an undiscovered public company is not a natural state. It's not something that companies hope for and dream about. And so it's really interesting to understand how this comes about. And so this question is for Bill. I'd like to start with you. Can you talk about how your company became undiscovered in the first place and some of the challenges of when you first took over the reins?
Yeah, I mean, I thought about this question, and frankly, it feels a little bit like what happened to Sangoma is what happens to most companies who fall into that undiscovered trap. You know, there's investors who were buying or could buy or had bought, and frankly, they stopped believing, right? Let's be honest. The company was a one product line company in a declining market. Revenue slowed, stopped, started declining, losing money. Strategy to get out of that mess wasn't very good. That's what led to the board saying time for a new CEO and a new management team and a new strategy. So I don't think, to be completely candid about it, it was any weakness in the public equity markets. It was a problem inside Sangoma that needed to be fixed. Sangoma wasn't doing what it needed to do. The market said, if you're not going to fix it, we're not going to invest, full stop.
Great. And Kurt, I'm curious to hear your perspective and how Xebec became undiscovered in the first place.
Yeah, so when we went public back in 2009, there was, I would say, some excitement about Xebec going public, talking about renewable gas, but the timing was not there. So there was no real market for the product that we were trying to sell. Therefore, there was no real performance of the company. And I would, say similar to what Bill said. If the company doesn't perform, investors are not interested sticking around, waiting out till you might something happen in the company or not. Given that the market wasn't there, there was not a lot of opportunity for us to go out, reach out to investors, tell a story that actually would resonate, because the macro background wasn't there. And I think that led to us falling back into being undiscovered after there was some excitement. And I think personally, you can become discovered and undiscovered multiple times. It just is a matter of, can you stay discovered for a certain period of time?
And sticking with Kurt and Bill, it's interesting. If you look at both of your company's stock charts over the last 10 years, they're almost identical. You see relatively high price in mid 2000s, then a downtrend in many years where the stock price almost didn't move outside of a very tight band, and then all of a sudden, which we'll talk about later in the panel, things start to work. But I'm curious, really, in that period where the price was languishing, did you ever look at the stock price and doubt that your strategy was going to pay off? And can you talk about maybe some of the challenges and frustrations that accompany many years of a stock price that goes sideways?
Yeah, I mean, what do you want me to say? That period sucked, dude, right? Like, it was just bad, bad, bad. I don't know how to make it sound better than it was. It was a situation in which the company didn't really have a plan, as I alluded to a minute ago. New management's brought in. You have to come up with an entirely new strategy and a plan for how to fix a company. You then have to capture it in some very simple way that internal employees and external customers in the equity markets can understand. And then you have to sell it. You got to make people believe that's really going to work. I'll be honest, that is a frustrating period for everybody, not just inside the company, but outside too, as people are trying to figure out, is this plan really going to work or not? I can say that while you're trying to work on eventually fixing share price, you can't pay attention to that at that time, right? Like, the share price is where it is because the company's not doing something to convince investors they should spend money on the stock. And so all of the attention goes into paying attention to the things that are, the leading indicators. How do you find customers? How do you build new products? And the lagging indicators like stock price just have to wait. There's nothing you can do at that stage to fix. At least, this is the 5th company I've run. I've never found a way to fix share price until you fix the company underneath. And so that's what we focused on. Think about how to grow revenue, how to find customers, how to build more products, eventually how to raise capital to fund some of that, which is a question I guess we're going to get to. And then you wait for the lagging indicators to take care of themselves later.
Great. Kurt, curious to hear your perspective.
Yeah, so similar. It's a really hard time. And the hard time is not so much because of the market. As Bill says, you can't really do much about the share price. There's no purpose in going out promoting your share. Nobody really wants to see an underperforming company. So there's not much purpose there. But the effort is on the internals. So retaining the key employees that you have. Because I think we are all knowledge companies. So if you lose your key employees, you lose basically your capital to be able to resurrect your company. Yeah. In our instance, it was a timing error. We spent about $60 million in R&D to develop the technology that actually allowed us to do this renewable gas purification. But the market just wasn't there. We were about 6-7 years too early in coming to market with that technology, and then you have to sit it out and basically wait. I did virtually no investor presentation from 2012, I think, till 2017. There was just no purpose in us doing anything because all the focus was on trying to fix the internals, trying to keep the key employees engaged, holding out hope that the market eventually will come around. And that is really a hard thing because you don't know for sure, is it going to come around or not? But that, I think, is what makes you the entrepreneur and the leader in the company, that you hold out the vision and say, I believe this is going to go. It's just not there yet.
Yeah. And it's interesting to think about a private company, and one of the challenges that they don't necessarily face is having a stock price that all their employees can pull up at any moment of the day and get kind of a read on what the market thinks.
Also your competition.
And your competition too is that
makes
every second that barometer is there. And I'm curious to hear, were there any certain tactics that you leveraged for retention when clearly the stock price, or did you employees not seem that engaged with the stock price?
Well, we gave them stock options, and now they're all very, very happy. But I would have hoped that those stock options would have had a bigger impact when we granted them, right? When your share price doesn't move for many years or in a very small band, the stock options are not very valuable, but they obviously sit there for, in our case, for 7 years. And now the employees are obviously very happy about it. But that's part of what you need to do. But it's not only a fiscal issue. It's also an issue that you give them the vision of what the company is trying to do. In our case, we are a bit of a feel-good company because we are in this environmental space where we reduce carbon emissions. So you can play different chords if you so want, but you need to be very focused to retain your key talent. Yeah, without your employees, your company is not worth anything.
Great. Dirk, let's go to you. You're a bit earlier in this process. Atlas just came public in November 2 years ago, and you came on board in October of last year. Since that time, the stock price has trended down. Well, I'm sure a lot of hard work is happening internally. Can you talk about that progress and your view, and when and how that will be eventually recognized by the markets?
I mentioned earlier that Atlas is but a startup. It's about 18 months old when we look at AEP. But it's a brave startup. It took on 6 companies scattered geographically across Canada. And we've spent an absolute enormous amount of time with the integration of these companies, the technologies. We brought everybody on the same engineering platform, for example, so that we can simplify the design, standardize it across multiple territories, give ourselves access to that. We've built a sales organization. The companies that has had a little bit of a runway with us all are reporting double-digit organic growths at this point in time. So it's really, really starting to pay off. But at the end of the day, it's all about people. It's about the quality of that leadership team that we're building, that we're surrounding ourselves. So what we've done is we really sort of gone into the company. We've assembled a good quality, visionary leadership team that is rallying our people around us at this point in time. So that is going exceptionally well. It's about fiscal discipline. It's making sure that we are using every dollar sensibly. And it is about our strategy of growth. It's 3 pillars. It is profit growth, and that is the first priority. It's organic growth through product development, through market coverage and penetration. But thirdly, also through further acquisitions. We're, like I've mentioned earlier, uniquely positioned for growth going forward.
Great. So now we're going to talk about one of, if not the biggest challenges of having an undiscovered stock, and something that will be of interest to everyone in the room, and that's access to capital. And when your stock is undiscovered, you can afford to wait sometimes, but for many companies, eventually they need to have that currency there to fund the company. So I'm curious if each of you guys could give your perspective of the challenge of funding, and how did those constraints impacted how you manage the business during this period of undiscovery. Bill, we'll start with you.
Yeah, so at Sangoma, we looked at that in 3 phases, to be honest. And speaking candidly, it's easier to delineate those 3 phases using revisionist history, looking back, and phase 1 ended here and phase 2 started there. It wasn't quite that linear. But phase 1 was stock price is too low, raising a bunch of outside capital is just too dilutive, can't afford that, so you're going to have to fund growth some other way. And for us, that meant funding it from operating cash flow and cash on the balance sheet to start doing the turnaround, building a bunch of new products to get out of being a one-product company, going from a company that sold only into SMB customers to a company that sold to SMB and enterprise and carriers and OEMs, and going from a company that was purely North American-based to a global business with customers and employees around the world. I guess I have a slightly different view about employees than my colleagues up here. When I came in to take over the reins, there were 30 employees at Sangoma. There's now 350. We kept about 15 of those 30. The other 15 opted out as the company changed. We went from a slow, muddle along, good job, show up when you wanted to. That's not how it works here. You got to be really serious and really engaged and want to work hard. And some people loved that and got re-energized, and some didn't, right? We went from a company that had 30 people in Toronto, everybody in one place, to 350 around the globe with 20 in Toronto. We now got offices everywhere. And then the second phase was operating results start to improve, share price starts to strengthen. Okay, you can begin to do some capital raise. It's modest. And then finally, as you get the recognition or the discovery that you're asking about, Brandon, you can finally get the benefits of being public, right? You tap into the equity markets, raise money in real amounts, some equity, some debt, now that the balance sheet is strengthened. But even at Sangoma, where share price has gone up very dramatically, as you said, you know, we've gone, as I said, from $7 or $8 million of market cap to $100 million EV. We don't have any multiple expansion at all yet. So it's discovered, but still discovered as a small cap, right? And so the opportunity then, as you get bigger and add scale, is for multiple expansion.
Great. Kurt, how did you guys look at funding constraints during this period, which lasted close to 10 years, as you mentioned?
Well, we didn't fund anything, so we sold assets. I was of the opinion that it's not worth going out raising money at 5 cents a share. The dilution would have been way too large. I was the largest, or I am the largest shareholder, so I was not really interested in dilution. So what we did is we restructured the company, downsized the company. As I said, we tried to maintain the core people in the company, to have the core know-how in the company, and then we started selling assets. As soon as I saw that the market was starting to pick up, I was fortunate to be able, but on my own, again, there was no investment banker or anybody willing to work with a small cap company in the 5-10 cent share price range. So I arranged a convertible debenture in late 2016 for $4 million. That was the first fundraising we have done in about 7 years. And then we did another convertible debenture. Again, I did it on my own. No investment bank was willing to do anything. That was in late 2017. Then the share price started to strengthen. As Bill says, then you start looking at what can I do on the public market. We did a small raise last year. Now the share price has doubled since then. And now we can hopefully start looking at further expansion, because we are growing also very rapidly. We were revenue of about 9.6 million in 2016, about 15 million in 2017. In 2018, we did about 25 million, and now this year we're going to do 45 to 50, and next year I expect that expansion to continue. So clearly there's then capital needs, but now the capital markets, you can work with debt, equity, you have different options. Investment banks are interested to work with you. So, but it's difficult. I mean, during this time period where your business is not performing, that's why nobody is interested. But to keep it alive is a challenge. Yeah,
absolutely. And Dirk, I'm particularly curious for Atlas. As you mentioned, you guys have done 6 strategic acquisitions and do have an aggressive M&A strategy in place. How do you balance the desire to grow through M&A with some of the challenges that come from having relatively illiquid, undiscovered stock?
You know, it's been interesting, because the year pre-listing, 2016, the initial company, Atlas Trust, back in Nanaimo, only did about $5 million. We're probably going to be looking at something close to 10 times that size this year, which is pretty impressive in any sort of by any sort of a scale. But each one of those deals has actually come with a different flavor to them, where it was funded through combinations of stock options to some of the owners, to private placements, through to some debt that we took onto the balance sheet, etc., etc. Really, where we find ourselves today is that we've reached that sort of economies of scale, where you actually start making a real big impact on the scalability of the business. Suddenly you've got buying power that is going across the country, and you can actually achieve some significant savings. The value of technology that you can suddenly afford now at this point in time, and that you can add to the mix, all of those are expanding the margins, growing the cash and the cash flows, etc., etc., and some cash is now falling back to the balance sheet. you're strengthening the balance sheet, you're working the debt off, and you can actually go back into that cycle again.
Great. I want to touch just for a moment on the investor relations component of this. And Kurt, you mentioned that you didn't speak to anybody for close to 5 years and that heads down running the business. But Bill, I know when we first looked at Sangoma and first invested that you conducted pretty extensive conference calls and talked to investors for hours. It seemed like on end, and it was interesting because many companies at your size and certainly your level of discovery at the time wouldn't even hold conference calls. So I'm curious to understand a bit how that strategy, did it work out for you? How did you guys land that was the best strategy for you?
Yeah, just trying to be really transparent and make it more interesting for the group. It wasn't nearly as well choreographed or strategically planned as it looks. Looking
I think
back.
you're selling yourself a little short there, Bill.
Okay, so we were willing to give it a try. That's the simple answer, right, Brandon? It was a lot of work at the beginning. This isn't my first rodeo, so I'd seen it done both ways before. For us, it was seen as an investment. We were going to give it a try for a year, do 4 or 5 quarterly calls. If it looked like it was helping and getting traction and investors cared about it, then we'd do more. And if it didn't, we'd save the time. The way we talked about it internally, if that's what you're looking for, is it was a way for us to communicate our say-do ratio. We wanted the markets to understand that if Sangoma said we were going to do something, come hell or high water, it was going to get done. And build a track record so that whether someone invested at that point in time and then could look back saying, oh yeah, I went and listened to your call 5 quarters ago and you said this was going to happen, or they didn't. They just said, that's really interesting. And then 3 years later came back and said, oh my God, I found out that what you guys said 3 years ago was really true. So it was an investment. I'll tell you that the question you're asking, I heard a lot of the time. For a little tiny unloved company, your calls are like a $500 million public company. You should keep doing them. It separates the wheat from the chaff. And so we kept going.
Great. So I think we've set the stage now of what the challenges look like for many years of undiscovery and how to manage to that. I want to shift a little bit now to start to talk about the inflection point where things began to turn. And all 3 of you have gone through this process to varying degrees, but Bill and Kurt in particular. And we'll start with you, Kurt. When did you first feel the inflection point where market discovery was finally starting to reflect the progress and what you'd worked so hard on over the previous decade?
Actually, I think it started to happen when the market for our product started to grow. So once I started to see that I actually had something to communicate to investors that might be positive, where the investors might actually see that there is some prospect of making money with our stock, I went out and started to talk about Xebec and the possibilities, and basically laid out a plan as to how we hoped to be conquering the market and growing in this market. Now, again, it comes back down to the management team. You're gonna say you're gonna do something, you need to do it. That builds the credibility in the market. That is what investors remember. Yeah. So if you go out and say, I'm gonna get a big order, you need to go and get a big order. If you're gonna say, I'm gonna do this, you need to go and do this. And I think that's what we have tried to do over the last couple of years. We have been relatively successful in doing that, and we've been awarded with a higher share price. Clearly, the market, the underlying economics need to work. If you don't have a product to sell, or if you're too early or your market's not there, there's no purpose in going out and telling a story that is not true and investors can't invest into because the market is not going to go.
Great. And Bill, when did you first feel the inflection point for Sangoma?
Yeah, I was trying to think back to this, and not exactly. I think it was late 2015 would be my guess. I look back at the stock chart that you kindly included, Brandon, and I'll tell you, that's a full 4 years after I took over the reins. So it took a long time to go through that turnaround. The operational and strategic benefits over that 4 years were visible. We were by then, I don't know, 3 to 4 times the size of when I'd first come into the company. That's net growth. You know, the gross growth was higher than that because some of it was offset by decline in the legacy business. it is a challenging time for sure, but when you see that inflection point happening, it's recharging for everyone, including the investment community. But if you thought about it, for the year or two before that, it sure was painful to watch share price languishing as the company was 3 to 4 times the size. It was generating profit and free cash flow. I just think that's the symptom of that undiscovered phase, right, that you're asking about.
Absolutely. And one thing that Paul and myself see from the investor side through this process is that when a company goes through the inflection point, they're so used to keeping the lights on, it can be hard to shift the mindset to a growth mindset and appreciate what the discovery process can actually do for their business. And so, Dirk, I'm particularly curious, you come into Atlas, which spent many, many years as a private company and now gone public, having access to capital. You've come on board with a renewed growth strategy. Have you experienced this transition from running lean, keeping the lights on, to shift into growth? And what are some of the strategies you've used to invigorate your team and execute the plan?
Absolutely. It's definitely where you have to transition from that point where the guys come in and they're just used to doing the things that they've been doing it all along on a private side. But when you come into the public sector side and suddenly you have this big growth strategy, some of the guys feel at times a little bit left behind. So it was extremely, extremely important to actually engage the teams and make them part of the vision. So suddenly they've got a point that they're chasing. So we've divided up the business the growth strategy into 3 perspectives. One was, like I mentioned earlier, profit growth. One was organic growth, and the other was merger and acquisitive growth. We removed the day-to-day operations from the guys completely on the merger and acquisition side. But what we did was we focused them, each one particularly on their role, their function on each of the organic targets that we were chasing. And we worked through each one of the barriers. And what has happened is the full team actually rallied. And they're excited, they're energized to actually chase the dreams that we're chasing at Atlas.
Great. And as this process unfolds and then the inflection point comes, one thing that typically happens is an expanding shareholder base and renewed investor interest. And a lot of times this can be a great thing. It can also be a bad thing. And so I want to read a quote by Warren Buffett we posted on Twitter recently to set up this question. It says, "Companies obtain the shareholder consistency that they seek and deserve. If they focus on short-term results or short-term market consequences, they will attract shareholders who focus on the same factors." So the question then, and this is for you, Bill, to start, how do you guys think about the type of shareholders you want to attract? And as you become more discovered and interest has increased, what strategies have you used to ensure that you guys get the best shareholders possible?
There's in my experience, the plan or the wish about the shareholders you'd like to attract, and the harsh, cold reality as you go through that process as a company. And at the beginning, I think every CEO worth his salt knows that you want larger shareholders more than smaller shareholders, institutional shareholders or desire, all the obvious things. But it's pretty hard to attract those kinds of shareholders at the beginning. And as you go through that inflection point, the kinds of shareholders you might be able to attract can change, right? And I think Sangoma was exactly like that. There's a phrase, beggars can't be choosers, right? At the beginning, you're kind of looking for shareholders. That's it, shareholders. Not which kind of shareholders or that kind of, you just want somebody who's interested in buying the stock. And then over time, as you build up a track record, you can become a little bit more opinionated. The profile of the shareholder base can change. I would say that for Sangoma, that was a pretty gradual process. We went from mostly retail, small shareholders, to retail high net worth investors, to family offices, to very small funds that you could argue were institutions or weren't, to what most people think of as institutional shareholders over a course of 5 years. And we've tried to be respectful to each and every one of those constituencies. It's really important in my experience that as you do progress along that curve, and you might be able to attract, a hedge fund or a pension fund or a mutual fund who's going to put in $5 or $10 or $20 million. The guy that has a family office with 50 million that bet on you with 2 million of the 50 3 years ago doesn't feel like they don't matter anymore, they've been left behind, or you won't take the calls. And so I spend as much time talking to shareholders who joined us 3 or 4 years ago, when the typical shareholder was a bit smaller, than I do the more recent shareholders that are much bigger, just for that reason.
Great. So let's shift now into the post-discovery phase. And as the companies have become more discovered, in particular Bill and Kurt with their stock price up over 5 times in the last 24 months. Kurt, this question is for you. What is the single biggest positive impact that has come about your business as a result of having a more discovered and ultimately higher share price?
I think the biggest impact is on the customer side. The customers are also following your share price. If you're a public company, the customers know you're a public company. And if your share price goes up, it's a positive signal about the health of the company. So automatically, you get a much better customer engagement, right? Also, what happens not only on the customer side, and then on the shareholder side, what happens is you can see that when you are undiscovered or a really low share price, you have a lot of retail investors, people who try to basically buy some shares, see if this goes, make some good money on it, and that's fair. So you stay and you make sure you engage with the retail investor community, you go out to those conferences, you have one-on-one meetings, roadshows, you do whatever you can to get your shareholder base. But once you start, your share price starts going up, you start gaining traction, your market cap goes up, some of the smaller institutions start showing some interest, so you start getting some traction. So where Xebec is today, what I can see is we are about an $80 million market cap company. So some of the institutional investors, which are, let's say, in the 2 to 5 or $5 to $10 million range, are starting to look at us. I'm not saying that they yet invest in us, but even at the $80 million market cap, which is significantly higher than where we used to be, still the majority of our shareholder base are retail investors. So as I can see us moving forward, I would hope that we can gain the trust of the institutional investors so that we see some institutional investor money come in as well.
Great, and that's a great segue. Institutional investment and sponsorship is one of the biggest challenges for undiscovered companies. And Dirk, I'm curious to get your perspective as sort of the smallest and least discovered of the panelists today. How do you guys approach this challenge, and how have you found success engaging with institutional investors?
Right now at this point in time, like was mentioned earlier, when you're a certain size, a specific market cap or revenue base, etc., some of these guys, they don't really look at you at that point in time. They want to see some results. They want to see some credibility. They want to see that you reach a certain size in market cap or revenue or profitability, etc., and or a combination thereof. But it is extremely important that whilst we're building towards those parameters, that we're engaging in those discussions, and actually market it out there. We have a really good investor relations group. They work with us. We market with these guys. We have regular road shows, regular meetings, etc., etc. And from an Atlas perspective, what has been happening is more and more of these guys are actually now getting on board. They want to come and have a look at the facilities. They really want to see where we're going. But I think it is building that awareness in front of these investor groups that is the most important thing for us.
Great. And so we're coming up on our final question, and it is an important one. This one's for you, Bill. Well, discovery brings many of the benefits we've talked about, a higher share price, more access to capital, it also brings with it a pressure to perform. Have you felt this pressure, and if so, what strategies have you employed to manage the higher expectations?
Yeah, I thought about this. I actually don't feel extra pressure now, to be honest about it. You know, the way I think about this is people who are not founders and are professional CEOs who've run multiple businesses, very large companies around the world, like the people who I try and put on our management teams, you know, they're making a bet with their career that's typically bigger in terms of the impact on them than a diversified bet that an institution is making, right? You got a $1 billion fund or a $200 million fund or a $10 billion fund, and they slice it up. And this much goes to large cap, and this much goes to infrastructure, and this much goes to small cap, and in the small cap, this much goes to tech, and this much goes to bioscience, blah, blah, blah. So the huge pressure inside Sangoma was at the very beginning. When people are trying to figure out, is this where I'm going to bet 5 or 10 years of my life in this company that no one knows where it's going, and you know they're working 24/7 around the clock, that's very high pressure. And at this stage, people keep working hard because they feel like, you know, there's traction. It's finally working, right? The pressure of the markets now being aware and paying attention, you know, for sure the management team sees it, you're right, but they see it in a way which is partly validation and partly pressure. And I think the validation of, oh, I worked my butt off for 5 years to get us here, and somebody acknowledges that that work they put in is paying off and valued, more than outweighs the pressure, you know, and that might be different for an entrepreneur founder than for a team that's brought in to rebuild a company. I'd acknowledge that.
Great. So at this time, I would like to open it up to the audience for any questions for our panelists this afternoon.
Real quick question, Brandon, this is actually for you. For those who may not know, what is the small cap discovery's discovery process?
Yeah, so the small cap discoveries process is really all rooted in finding these companies long before the mainstream market does. And so there's always, as we've tried to touch on today, there is a big disconnect from when people discover the process in the outside markets, the higher share price, the breakout earnings report. As an investor, a lot of times it's too late. And so what we've really devoted our lives to and through small cap discoveries is learning how to identify the companies and when the process is unfolding long before it's obvious to other people. And it's far more of an art than science. And so what it involves is a lot of manually screening filings, looking for small clues that things are moving in the right direction. Flying to the far reaches, corners of Canada, meeting with companies where they tell us, you know, investor hasn't called in over 6 months or a year, and getting really excited about that, and really looking at thousands of companies just to try to find a handful, like those that we have here today, that things are moving in the right direction even when no one in the market is paying attention, and trying to be positioned and patient for when things hopefully eventually unfold. And so that's really what we're all about and what we hope we were able to showcase today.
I had a second question, and that is really to the panel. And when was it, and what did you do about it when you had no interest in the stock's going sideways, you're pulling your hair out, you're under pressure, and did the thought of going private ever come into your mind, or were you always destined to stay as a publicly traded company?
Great question. Bill, would you like to start?
Yeah, you know, that's a time when I think boards of directors play one of the most important roles that boards play as a company evolves, thinking strategically about where the company should go, what's the right ownership structure. We did debate public versus private. You know, the dirty little secret that lots of folks don't realize when you talk about taking a company private is you still got to find someone to buy more than half the shares, right? So it's not just a delisting. Someone has to be interested in that business and willing to pay enough that the shareholders who own the shares think, oh, I'm willing to sell. So when Brandon talked about the share price curve for Sangoma before I came in, you know, that price was, I don't know, 8 times what it was at that point, right? So if you bought the stock when it was $1.80 and now it's sitting at 30 cents and someone comes in and says, I'll buy it for 40 cents a share, it's very hard to find half the shareholders who are interested in selling to take the damn thing private. So, you know, that's a matter of a board thinking through how confident are they in the corporate strategy that the CEO proposes, and there's a direct relationship between the question about what should the ownership look like and how confident are you in that CEO and the plan.
Well, I can also add something. I tried to take the company private back when we were like a $4 million market cap. You know, given that I was the largest shareholder, I had a good position and be able to take the company private. But as Bill says, you need to find the shareholders who are willing to sell the company once your share price is that low. What I found is most people said, well, you know, if it's 5 cents or 0, it doesn't really make a difference to me. And unless you're going to pay me 30 cents, I won't sell my share. So it's not a matter of where you are with your share price that you can take a company private. It's really, you need to find the shareholders who are willing to sell at the price that is justified at that point in time, which is not easy to do. I think taking company private is a challenge in itself. You also have a board, you're public, you need to deal with that whole aspect of the transaction as well. So shareholders are key in that.
Great.
I think from the perspective of private versus public, it depends on also what your shareholder profile is and how much insider shares you have and what your relationship with some bigger shareholders, et cetera, is. But when the board is actually sitting together and the CEO is working with the board and looking at what the forward positioning of the organization, the business is, and you're actually taking into account at that point in time what's in the best interest of the shareholders. I think that is what's the main driver for that decision at the end of the day. It's easy to say, oh, we're going to take it private or we're going to do this or that. But when the best interest of the shareholder is, and all shareholders for that matter, is part and parcel of that decision, I think that is where the win strategy really is.
Ash?
Yeah, what do you think when now that you've come a long way, you've kind of faced your challenges. What makes you not sleep at night? What do you worry about moving forward? What are the biggest risks that you see for your companies, each individually there, to losing your momentum?
Bill?
The things that keep me awake at night are no longer as much things that are within our control. There are some, but they're not the biggest 2 or 3. The stuff that keeps me awake is macro stuff outside Sangoma. I worry a lot about, because we're a global company operating all over the world's a bit of a crazy place right now, right? It's crazier every year, it seems, and whether it's the situation in North Korea or what we saw over the space of the last few days, or Brexit, or instability in Venezuela, or go on and on, that stuff worries me, because that can affect a whole bunch of economic factors like just the economy generally, like interest rates, like foreign exchange. If you're a company like us that operates around the world, we sell almost exclusively in US dollars. So the movement in US dollars versus local currency is something we deal with all the time. You get crazy effects, right? You get a decent size order in Russia and the ruble moves by 50% in 3 weeks, and all of a sudden the guy says, yeah, we want to pay you. We just want to pay you half of what you quoted when we bought it, right? But please let us keep the product. So that's the thing that bothers me most, I would say. And then secondly, maybe just the difficulty in managing a very globally diverse workplace. We're a company that's much bigger than it was, but it's still a small company, right? 350 people. We have 350 people in, I don't even know now, 25 countries and 50 cities. It's tough, right? We had a call for an executive who was leaving this morning, and how would you normally do? You pull everybody in a room and you have, pizza and cake and a a beer and say thank you for all your hard work, and now you got people on a phone call from 50 different places. It's not quite the same. So that's the other thing, is just keeping that culture strong through growth phases when it's so distributed.
Yeah, for me, so what keeps me up at night are basically two things at this point. One is execution. We are growing so rapidly that executing is key. And that's what I say to my management team and where we are focusing on internally to make sure that happens. The other thing is that the company is getting bought at a time, so taken over by a larger entity at a time where we didn't have a chance yet to create real shareholder value. So, and that is for a small cap company always a big risk, because if you look at a multi-billion-dollar market where you are the only publicly traded company in, yeah, there are other private competitors, but if you are like the leading technology firm that's public in a space like that, that's worrying, right?
From our side, we actually have confidence over the things that we control ourselves. I think I want to agree that some of the macroeconomic items, that could be a worry at times. But I think really from where we are at this point is there's not too much that actually keeps us away at night other than excitement for the future, to be quite honest. Thanks.
If each one of you had a silver bullet, which competitor would you go after and why?
Bill, you want to start?
So one of my pet peeves in the world is valuation discrepancy between Canadian publicly traded companies and US publicly traded companies. And one of our lines of business, although not the only one, is a cloud business. That business is growing very quickly right now. It's a really good business. It's all recurring revenue. Sangoma has about $100 million in revenue and $100 million EV. Our nearest competitor in that space is bigger than us, but not large cap for US thoughts. In the US, a $500 million company is not large cap, and that $500 million competitor has a $6 billion market cap. I'd like to own that $6 billion company.
Well, for me, that's not really an issue. We have private competitors. We are the only public company in the space, so I can't really compare myself to any other public entity. On the private side, there's really no competitor I would be willing to buy because we have the leading technology. And we've been offered companies to purchase, which we haven't followed up on because I don't see the benefit in it. I think for us, it's organic growth as quickly as we can.
One silver bullet is not going to do it. I need a lot of weaponry. Where we find ourselves is you need to understand the fragmentation of the industry in which we operate. We're talking about hundreds and hundreds of family-owned businesses or regional players. There is absolutely nobody that is doing what we've done or what we're busy doing, and that is rolling up this industry. There's no national brand. There's no company that can service customers from coast to coast or across multiple territories. Atlas is the only ones that can do that. So we're actually heading out with, we should connect after because I need a couple of those silver bullets because we need to make a few more acquisitions.
What are your thoughts about the future of crowdfunding as a tool? The more that your company becomes known and the more exposure you get, crowdfunding seems to be a very profitable way for the company to raise funds and not suffer as much dilution as maybe convertible notes and other things of that nature.
Bill, would you like to start?
Not particularly. I'd say that crowdfunding is not in our future. To be honest, we don't need convertible notes. We don't need warrants or special approaches now. It's going to be common shares, normal secondary offerings. I think we did one private investment in public equity. That needed a few conditions. I didn't love that. We're going to be short form prospectus listed in the next little bit, I think, and so we'll just be issuing shares if and when we need equity capital.
Yeah, same here. I don't see crowdfunding play a significant role in our funding strategies going forward.
I think from that perspective, I share the same view, but we are also investigating, looking at what is the value propositions that crowdfunding could potentially bring, because there is certainly an attraction for what it can do, and especially when you're starting looking at a very aggressive growth profile, it may be one of the tools in the toolbox. Thanks.
Great.
During the period of your pre-discovery, there's an awful lot of opportunities to listen to people who want to promote you by being paid and writing a report that way. Given the fact that there's not a lot of analysts around who can write up your companies during that period of time, it's very, very difficult to get any news out. What is your opinion on paid promotion, and how do you see it from your perspective?
Good question.
Me to go again?
Yeah.
I don't want to answer that one. So we tried a little bit of it. We dipped our toe in the water, tried it for, I don't know, a few quarters. My personal experience has been a little negative with that, to be blunt. It doesn't mean that that's the only experience I've had. In other companies, we've had a bit more success with it. I know lots of other CEOs who've had good success with it. Our experience was, for me, it was a means to an end. The end is it affecting awareness, trading volume, and therefore share price? And what I observed was quarterly reports listing all the activity those firms did that we paid them to do. Here's how many emails we sent. Here's how many calls we made. Here's how many people dialed into a webinar. And I'd say, I don't give a crap about any of that. What I care about is anybody who's paying attention to any of it doing anything. Are they buying our shares? Are they getting the message? And if they're not, the means to an end is not creating the end. We stop doing it.
Well, most of the investors know if it's paid research. So as soon as it's paid research, they discount it to a certain degree. And we never went this way. We focused on some direct investor engagement. I did that. We did some social media, digital marketing, things like that. I think that's more purposeful than trying to get somebody to publish a paid report about you, which most people discount, most investors discount.
I think in my past lives and current lives, in totality, I've used both sides of it. I can categorically say that there is huge merit in actually building, branding a strategy where you could actually promote your business to and through investor networks, 100%. But not all strategies are created equally. So you get indifferent results if you're not careful, if you're not planning it out purposefully. And by the same token, not all organizations and or investor markets lean itself out to a lot of that. So you have to be very careful that you're not overly promotional, but that you're actually factual and that you're actually adding value to your share at the end of the day.
Can I add one 30-second thought?
Sure.
Yeah. Although it's kind of a half step towards the specific technique you've asked about, which I shared wasn't hugely successful for Sangoma, before you can get unpaid research, full analyst reports, correct, one of the things that worked very well for Sangoma is well-researched newsletters, right? And that's not from one of the big, top 5 investment banks who you just can't get attention from, right? Example.
Full disclosure, I wrote one of these for the MicroCap Club. Conferences
like this, right? That is seen, in my experience, by the investors you're trying to reach as more credible than the purely paid IR work or paid research. And that's kind of a step in between, I would say.
Great. We're out of time?
I think we're wrapping it up, but why don't you let us all know what time you're presenting tomorrow, so if somebody wants to come see your presentations.
I'm incredibly embarrassed to say. I don't know. I think I'm presenting at 10:30 or 11:30. I know it's in the morning.
Bobby, do you have it? Wait, Bobby will get it. Bobby will get it.
Yeah,
10:30 in the morning. Please come
Sangoma,
see me.
10:30.
yeah, I'm at 9. Track 1, yes.
4:30. 5:30. Okay.
5:30.
Oh,
I'm,
great.
I'm still on Alberta time.
Well, I'd like to thank you all for being here. Thank you, Brandon. Always
Thank you so much.
fantastic.
Thank you, everyone.
We're
Look
now
forward to
having
seeing
a
you all.
short break for everybody, and please come back here by 5:04. So for our next panels, thank you all.
Awesome. Thank you.